While being slightly fast-paced, the NUBURU stock closed its last trading session on the NYSE American at $0.46 on October 9, 2025, which reflects a staggering intraday decrease of minus 29.38% from the previous close, a significant pullback that comes after a truly parabolic multi-day rally. The market is now closed, yet the seismic activity around this stock demands immediate, deep scrutiny. We are seeing a massive tug-of-war between the euphoria that drove this microcap's value up by over 400% in 8 consecutive trading days, and the gravitational pull of fundamental reality and profit-taking that slammed the stock down by nearly a third in the final session. But here is the critical insight that the surface-level panic misses. The core catalyst that ignited the rally, the pivot to defense, and the binding agreement to acquire Italian software firm Orbit SRL remains fundamentally intact, a transformative strategic move that fundamentally alters the company's risk-reward profile beyond its legacy blue laser business. This expectation of a high-growth defense technology future is now clashing violently with the reality of an extremely volatile, low-liquidity stock prone to massive swings. The conventional wisdom for BURU has been simple. It's a high-risk, low-revenue, blue laser technology company struggling with liquidity and execution. A typical nanocap stock best avoided by serious investors utilizing platforms like Schwab Intelligent Portfolios or seeking safe harbor with Fidelity's wide range of Fidelity mutual funds or conservative Fidelity ETFs. This viewpoint, however, is now dangerously outdated. The current narrative, the one driving the speculative frenzy, is that the company is no longer just a struggling blue laser firm, but a newly minted defense and security play, tapping into a multi-billion-dollar NATO/EU operational resiliency software market. This belief is the reason the stock soared from around $0.12 to highs of $0.65 in a little over a week. Our deeper analysis challenges this revised expectation by pointing out the extreme execution risk. Transitioning from a capital-intensive hardware business to a software-as-a-service defense contractor is an unproven, high-stakes gamble, fraught with potential dilution and integration challenges, even as the dual CEO structure is implemented to manage this exact pivot. This tension, the immense potential of the defense pivot versus the existential risks of a financial turnaround, is what will define BURU's price action for the remainder of the year and why every tick is currently a battleground. Zooming in to the recent price movement, the week's trading volume has been nothing short of explosive. The colossal spike in trading volume, reaching hundreds of millions of shares on certain days, far exceeds the 90-day average, indicative of extreme retail investor attention and high-frequency trading activity. This is not the measured accumulation of a major institution, although we do see minimal institutional footprints from the likes of Vanguard and Geode Capital Management, albeit from the last filing date in June 2025. This momentum is overwhelmingly fueled by the retail crowd, congregating on platforms like Robinhood, where fractional shares make highly volatile, low-priced stocks accessible, and through social media channels that broadcast the narrative of the defense acquisition. The initial surge was directly tied to the announcement of a $12 million public offering to fund the strategic transformation, followed almost immediately by the October 7th announcement of the binding agreement to acquire Orbit SRL. This one-two punch provided both the funding and the strategic direction investors desperately craved, leading to the phenomenal multi-day winning streak. The massive sell-off we saw on Thursday, October 9, 2025, a day when the stock plummeted nearly 30%, is a textbook example of a momentum trade unwinding. A sell signal was issued from a pivot top, and the steep decline, even with volume pulling back, signals that a large portion of short-term traders are taking profits, fearing the run is over. This intense volatility, with a weekly range between $0.121 and $1.60 on a 52-week basis, makes a strong case for investors to consider using a more robust trading platform like Interactive Brokers, which offers advanced tools and margin requirements better suited to managing such extreme risk, compared to the often simplified interface of a retail app like SoFi Invest. The core issue for the stock's short-term health is the fear of dilution. While the $12 million raise is crucial capital, the nature of the public offering involves warrants and a significant increase in the outstanding share count, a move that weighs on the stock's price even as it shores up the balance sheet. The company's pivot towards the defense sector with the establishment of NUBURU Defense LLC and the acquisition of Orbit is the singular most dominant factor in its current valuation. Orbit SRL, an Italian firm specializing in operational resilience and defense-grade software as a service, is a direct move into the $2.9 to $3.6 billion addressable market across US, EU, and NATO defense organizations. The move is a desperate lifeline and an aggressive growth play simultaneously. The old business, developing and delivering high-power, high-brightness blue laser technology for welding and 3D printing in e-mobility and consumer electronics, was struggling immensely. Recent financials show this grim reality: a paltry revenue of $9,300 and massive negative earnings of nearly minus $37.7 million, with negative shareholder equity and a critically low current ratio of 0.04, screaming of liquidity challenges. The company was essentially on life support, facing non-compliance notices from the NYSE, which makes the magnitude of the recent rally on the back of a strategic pivot and a relatively small $12 million raise all the more astonishing. The market is pricing in the potential of the new business, a $6.6 million Bangladesh government contract secured via the Techne partnership, and the projected future revenue of Orbit SRL reaching $19.29 million by 2028, and ignoring the massive structural financial weaknesses of the old business. This highlights a fascinating psychological aspect of online investing. Traders are willing to overlook years of poor performance for a single, compelling narrative shift, especially in a sector as hot as defense technology, which is currently enjoying massive sector momentum due to escalating global geopolitical tensions. Investors need to be sober about the potential conflict of interest, too, as the Orbit acquisition involves a related party transaction with NUBURU's executive chairman and co-CEO. Looking ahead, the future outlook for BURU is binary, high risk, and entirely dependent on the successful execution of this massive corporate transformation. The key catalysts to watch are the hard deadlines for the acquisitions, specifically the finalization of the Orbit acquisition agreement by October 31, 2025, and the subsequent integration. Success will mean BURU genuinely transforms into a defense tech company with recurring software revenue, justifying the sudden upward re-rating in its valuation. Failure, or even a delay in regulatory clearances, particularly in Italy, will see the stock price likely revert to its previous penny stock levels, as the old blue laser business is not a viable fallback. The risk of future dilution remains extremely high, as the company still requires significant capital to fund its aggressive M&A strategy and continue operations despite the recent $12 million raise. For those engaging in self-investing, especially with highly volatile stocks like this, it is crucial to understand that the stock's incredible volatility, the 0.12 low to the $1.60 high over the past year, is characteristic of a deeply speculative security, not a stable compounder like Apple stock, or a predictable high-growth engine like Tesla stock or Nvidia stock. This is an entirely different caliber of risk. The company's ability to generate revenue from the defense sector immediately, particularly the $6.6 million contract, offers a crucial bridge to profitability. The reality is that for every aggressive growth catalyst, the dual CEO structure, the $3.6 billion defense market target, the $12.5 million Orbit acquisition, there is an equal and opposite financial risk: negative equity, minimal cash, and extreme dilution risk. Investors should be prepared for more extreme volatility in the coming weeks and months as the market digests the recent gains and attempts to gauge the probability of success for this audacious corporate pivot. The stock is a high-stakes, high-octane speculative play, not an investment for the cautious portfolio. Comment below how many shares of BURU you currently hold, or if the recent volatility makes you think twice about investing in microcap stocks. Ultimately, the expectation that NUBURU is a reborn defense powerhouse is currently built on paper, on binding agreements and projected revenue, not on fully realized quarterly earnings. The reality of the recent 30% crash shows the inherent fragility of that expectation. The true authority in this market comes from recognizing the fundamental disconnect. The narrative has changed from industrial lasers to defense SAS, but the financial structure supporting that narrative remains dangerously weak, a fact that any savvy online investment strategy or careful look at investing sites would immediately highlight. The next few quarters, not the next few days, will determine if this historic rally was a fluke or the beginning of a true corporate phoenix